This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, McDonald's just dropped a bombshell warning, and this is something that has investors outright frightened. But this isn't the only thing that's keeping investors in the fast food giant awake at night, as new evidence suggests that the U.S. economy is getting worse. But one thing that's getting better, that is the revenues and profits. For our sponsor for today's show, CDT Environmental Technology, is back. You can find them on the NASDAQ and the symbol CDTG, and the reason you do is they're a profitable company that's expected to see even bigger revenues, as they just partnered with a Fortune 500 company to bid on a $160 million contract being issued by the Chinese government. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Fox News, where we picked today's story up with a headline as McDonald's is ending AI drive-through ordering. And this is a huge problem for investors, because right now many people are bidding up tech stocks on the hope that AI technology is going to drive massive profits in stocks. And now we're seeing McDonald's pull out of this space, and there's only one reason we can accept, and that is it's not ready for prime time. And in a message from Chief Restaurant Officer Mason Smoot, he said, after a thoughtful review, McDonald's has decided to end our current partnership with IBM on AOT, or automated order taking, and the technology will be shut off in all restaurants currently testing it no later than July 26th of this year, indicating that it is not working. This is a big problem for companies like McDonald's and other fast food restaurants that are looking to cut costs. As minimum wages and inflation have gone up, they need to cut back on employee hours and the amount of people they need running their restaurants. This is technology that was supposed to make a big difference, and a lot of companies investing big money in it, and now we're finding out it's just not working the way people hope. And more than 100 McDonald's locations were testing the technology dating back as far as 2021. And while there have been more success to date, we feel there's an opportunity to explore voice ordering solutions more broadly, suggesting it's not as good as everyone hoped. And they went on to say that the company will make an informed decision on future voice ordering solution by the end of the year, as they scramble to look for any cost-saving measure. But I want to know, what do you think? Are you ready for the AI revolution? Do you think the technology is mature enough, or do you think this is just maybe a blip in the road onto something better? Weigh in the comments below what your experience is. However, the fast food giant reportedly told restaurant business that the goal of AI order taking program was to see if it could simplify operations and speed up service to customers, and the bottom line is it didn't, because if it did, not only would they be rolling out to all their restaurants, but you would see more companies adopting the technology in a big way. And maybe in some spaces it is working, but this is one it's not. Consumers not ready for it, and the technology just not mature enough. And as we move forward, our work with IBM has given us the confidence that a voice ordering solution for drive-through will be a part of our restaurant's future. The reality is it has to be. There's no choice around this. Again, you look at California, which has this massive minimum wage for restaurant workers. What they're going to see is they have to do anything to cut costs, to automate and implement technology wherever possible. This has to absolutely work for not just for McDonald's, but again, other fast food restaurants in the same space. IBM told the restaurant business that it developed automated order taker technologies with McDonald's to support the emerging use of voice activated AI in restaurant drive-thrus. Of course, IBM hoping to be a leader in that space, and it's going to be highly competitive because companies are going to be desperate to save money. The technology has proven to have some of the most comprehensive capabilities in the industry, fast and accurate in some of the most demanding conditions. And while McDonald's is reevaluating and refining its plans for AOT, we look forward to continuing to work with them on a variety of other projects, suggesting it's not as good as everyone hoped. And this is a problem because the economy is indeed starting to slow down. down. The cost to run a restaurant have gone up, and they need to save money in a big way. But if you're looking to invest and take advantage, this is something we talk about on our Sunday shows. As we look at the stock of CDT Environmental on the NASDAQ under the symbol CDTG, here you can see the volume profile. If you're looking to invest in a profitable company, one thing you definitely want to do is make sure other people are buying underneath. That's what this line says over the last 90 days, and we think that there is a big setup to stake this stock higher. Stay tuned to the end of the show, but as we look at, of course, the U.S. economy, the problems for McDonald's are about to get much worse because, as we've noted, they've already said their customers are experiencing a problem. They just don't have money, and they're turning away as low-income consumers are tapped out, and now even middle-class consumers are finding themselves falling behind. And for, of course, a restaurant that needs quick service and low prices, they're not getting it. And here's why it's going to get worse: as New York manufacturing shrinks less than forecast as prices cool, that means demand for the economy is getting weaker. But there's an underlying part of this report I'll show you that's really key. As the Federal Reserve Bank in New York's General Business Conditions Index increased 9.6 points to -6, now still in contraction, which is below zero. The gauge of prices received by state manufacturers dropped 7 points to 7.1, while an index of prices paid for materials decreased to the lowest level since the start of the year. And this is important because, many people believe inflation is going to resurge. In fact, the Fed says they need to stay on hold because that's their biggest fear as inflation comes back. But here we see at the New York Fed manufacturing survey, it's very clear that prices paid decreased to the lowest level since the start of the year. That, my friends, is not inflationary at all. But the problem, we come back to McDonald's. What they're facing is people cannot afford to eat there, and that is an issue, and it's going to get worse as now we look at the employment part of the New York Fed manufacturing survey that says the index for number of employees came in at -8.7, meaning on net there are more people being laid off in the manufacturing sector than being hired. And here's a big one: the average work week fell to -9.9, pointing to an ongoing decline and contraction of hours worked. And as people have less money to spend and they go on unemployment, even worse, that means companies like McDonald's are going to be vying for an ever smaller pool of customers. And now you can see why they need AI technology so bad. As manufacturing conditions continued to remain weak in New York State, and despite lackluster conditions, optimism about the 6-month outlook rose to its highest level in 2 years, because sometimes hope is the only answer. When things get bad, you start to think, well, maybe they can't get worse. The problem is, I'll show you why, they're going to get a lot worse, and not just for New York, because the U.S. has been stuck in contraction territory for all but 1 month since October 2022 amid weak demand. There's a key part, and you note as people lose their jobs and get less hours, demand is not going up. That's what's baffling. You see they're optimistic, but they're not being realistic amid higher borrowing costs and limiting new investment. The New York Fed's regional gauge of current orders, while still showing contraction, and I'll show you why likely to get worse, is the highest September, but again, still in contraction. And as, of course, new orders continue to decline and backlogs get worked through, what we're going to see is more sections of the employment reports say that we don't need as many workers and we don't need the workers we have for the hours we do have available. And that is a huge problem. It's going to lead to a further decline in spending. As we take a look at the diffusion index for the New York Fed manufacturing index, you can see here it's normally fairly smooth. You see it follows very consistent path, but it's been choppy and all over the place. That the bottom line is the trend is lower and likely to get worse. If we take a look at advanced retail sales, now shown in red on a year-over-year rate of change, what you can see is slowdowns in retail sales, and this makes perfect sense, lead to less demand from manufacturers. And you can see that event here going into the global financial crisis between 2011 and 2013. You see it come up again in 2014, again in 2018. And look at now, despite the choppiness of the report, retail sales continue to slow. And while we'll get the new data on retail sales tomorrow, the evidence suggests it's likely to head lower, which is interesting because the market thinks otherwise as Treasuries fall in countdown to U.S. retail sales, as the market believes the U.S. consumer is strong and robust. But it doesn't make sense because we saw continued unemployment claims go up over 1.8 million last week. We saw initial claims rising above that, finally above that 212,000 mark. We're seeing hours worked getting cut, and yet the market expectation is yields climbed in a run up to retail sales figures, which are expected to remain tepid as consumers avoid dipping further into savings. The issue is I'm about to show you they have no savings left or borrowing at elevated interest rates to finance their spending, also something they don't have the ability to do. And that's the big change in this economy, is companies like McDonald's are desperate for customers and they're desperate to save money. They need things like AI to work in a big way. Here we can take a look at advanced retail sales, now shown in blue against the personal savings rate. And I want you to see that the savings rate currently is near historic lows. It's not quite there, but it's down in fairly low levels. And I want you to see is declines in personal savings, while they do lead to a short-term boost in retail sales, they ultimately lead with a lag to a decline in retail sales as consumers run their savings down. And then if the economy doesn't turn around in their favor, well, they have to start saving money and cut spending. And sure enough, that's exactly what we see now. This big decline in personal savings actually was matched with a decline in retail sales, mainly due to the pandemic stimulus going away. But here you can see savings rate going down, retail sales likely to head lower as consumers all but tapped out. And we can see it in their wages as we look now at total compensation, this shown in red, average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. We look and see that the effect this has on retail sales, and usually what you know is that slowdowns in total compensation are matched with a slight lag of a decline in retail sales. You see that now, and we're getting more evidence now from the New York Fed that hours worked are declining, meaning total compensation will head lower and consumers have less money to spend. But the problem is they don't even have credit available. As we now look at the delinquency rate here, we can see with credit cards it is high and likely to head even higher. And when that happens, when consumers cannot access credit to buy things they don't need with money they don't have, well, they tend to not spend. And sure enough, what you see here is the likely effect of tomorrow's retail sales report and future retail sales report is we're going to see a decline because there just isn't demand, there just isn't availability of credit. And even worse, the jobs market, as we look here now at continued unemployment claims, this ticking again above 1.8 million, suggesting that you see declines in manufacturing tend, not always, but do tend to match rising unemployment claims. It's a simple reason, because when people have less money, well, they don't spend as much. And this is creating an opportunity, according to Goldman's Rosner. He says buying opportunity coming after a sell-off in fixed income, suggesting the path forward is not high-flying tech stocks, but perhaps the bond market. As valuations are really important, your entry point does count, he says. We feel like there could be some opportunity to have a better entry point in fixed income. And of course, we look here at Sam Stovall seeing increasing fragility in the markets dominated by a few themes without broad-based signs of strength. He poses a question: how long can the jumbo jet keep flying on only one engine? A nod to the tech-dominated rally in equities that has masked signs of weakness below the surface, not to mention the U.S. economy. And this is something that's important to understand, because when retail sales fall, how do you get people to come in and buy? Well, higher rates isn't the answer. And sure enough, as we look at advanced retail sales against the market yield of 10-year treasuries, what we can note is a fairly consistent relationship between the two. But what's interesting is why we've seen a broad slowdown in retail sales. The market believes that rates need to go higher, and significantly higher. What that suggests is as long as rates stay elevated, retail sales are going to plummet until rates come crashing down and give consumers some ability to borrow and spend. That is what's going to change everything here. Rosner goes on to say the run-up in valuations has intensified inside the market's game of narrative roulette with an ever-evolving set of explanations for why asset prices keep defying gravity. We've heard that from a number of guests. The data make it hard to avoid the conclusion that the run-up in equity prices, for example, is anything but a tech-driven, perhaps AI-driven friendly, and the AI theme has been applied and it's mostly turned into a macro story. As a challenge for me is on AI is there's only a small number of companies able to demonstrate they're generating revenue from it, and that's the problem. But if you're looking for a company that's generating revenue and profits, look no further than the sponsor for our today's show, CDT Environmental Technologies, on the NASDAQ on the symbol CDTG. Let's make the case of why we think their stock is likely to head higher, as they have a long track record of successful projects, completing more than 60 rural soils treatment plants all across China. And they have growing revenues, gross profit, and net income. And this is impressive because they're expected this year to drive revenues between 42.5 and 47 million, with a net income of somewhere between 8.7 and 10.2 million, meaning this is going to be a huge catalyst for their stock. And what could drive it even higher is they just announced a partnership with a Fortune 500 company subsidiary to jointly bid for large-scale sewage treatment facility in China. And this is a big opportunity for them because the total contracted value is estimated to be worth approximately 160 million US dollars. And the project, which is being spearheaded by the Chinese government under an approved budget, consists of 3 phases, which are expected to ultimately establish a 400,000 ton per day water purification facility. And this is something, of course, if CDT Environmental gets this contract, could be a huge win for their stock. And this is why you're seeing investors come in and putting support underneath it. We looked at the 90-day chart. Let's now take a look at the 30-day chart. You see here, this is a fairly new issued stock. And what we note is every pullback, buyers are stepping in, creating a big opportunity to take this stock even higher. But as always, with any company we feature on our show, you're no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.